Welcome back, focused learners. We're jumping right into another explainer today, and honestly, we've got some pretty dense, freshly released Q1 FY27 data for Muthoot Capital to unpack. Now, if you follow the consumer finance sector, you already know that keeping a close eye on these quarterly metrics is absolutely essential. It's how we evaluate a company's true financial health, their risk management, and their overall trajectory. So, we've taken a massive, complicated investor presentation and distilled it down to just the numbers that actually matter.
But before we even think about looking at a balance sheet, we really need to appreciate the underlying value of trust in the financial sector, making markets function better. This is the mission statement from crore, a global analytics company, and it's a powerful one, because in the world of non-banking finance, numbers on a page mean absolutely nothing without independent, rigorous evaluation. So we're going to use this concept of rigorous market evaluation as our macro-level anchor for today's deep dive.
Okay, here's our game plan for today. We're covering 6 main areas: the value of financial trust, a look at their 30-year market legacy, breaking down the portfolio, measuring growth and disbursements, checking in on asset quality and risk, and wrapping up with strategic partnerships and recovery. We're going to take these complex corporate metrics and break them down into totally logical, bite-sized pieces. Let's get right to it. Section 1. The value of financial trust. Establishing the baseline. Let's set up that macro lens of rigorous evaluation I was just talking about. So, think of a credit rating like a vital corporate pulse check. It's basically an independent evaluation of how capable a company actually is of handling its debt. crore pioneered this whole concept in India way back in 1987, introducing a desperately needed standard of analytical rigor to the market. And it's this exact kind of critical, independent lens that we're going to apply to Muthoot Capital's Q1 FY27 results today. We want to see just how strong their pulse really is.
Moving on to Section 2, a 30-year market legacy, from startup to powerhouse. Let's zoom in on Muthoot Capital Services Limited and establish the foundation they've built.
Promoted by the Muthoot Papachan Group, Muthoot Capital Services Limited is an RBI-registered non-banking finance company, or NBFC. They've been around a while, setting up shop in 1994, and today, they're widely recognized as one of India's most progressive automobile finance companies, actively listed on both the Bombay Stock Exchange and the National Stock Exchange.
To really grasp where they stand in Q1 FY27, you've got to look at their momentum over the years. They started out in '94, right? But the real game changer was in 2008 when they jumped into two-wheeler financing, which, as we'll see in just a minute, became their absolute bread and butter. Fast forward to 2019, they secured the Golden Peacock Award for Corporate Ethics, which proves a serious commitment to standard-setting governance. And look at their latest milestone. For the 2025 financial year, their assets under management officially crossed the massive 3,000 crore rupee mark. That right there is 30 years of compounding momentum.
All right, Section 3, breaking down the portfolio with a Q1 FY27 snapshot. Let's flip to their latest chapter and open up that report card. Right out of the gate, boom. 3,379 crore rupees. That is a massive total portfolio size that instantly validates their market standing. And for those of you tracking the technical details, yes, this figure does include an off-book direct assignment, or DA, of 81.58 crore rupees. That just means loans that have been sold off to other financial institutions. Now, what's absolutely fascinating is how that huge 3,379 crore sum is actually sliced up. They are an overwhelmingly retail-first operation. A staggering 84% of their portfolio sits right there in MCSL retail, which accounts for roughly 2,851 crores. Co-lending makes up 15%, and corporate loans and other products, well, they're just a tiny 1% sliver. This tells us loud and clear that their core competency is, without a doubt, direct-to-consumer retail lending.
So where are all these retail customers actually located? Well, South India is absolutely their undisputed powerhouse, holding the lion's share at 36% of their total assets under management. And the coolest part? It's not just the size, it's the sheer quality of that segment. South India boasts their lowest regional gross non-performing asset rate, or GNPA, at a highly efficient 3.0%. North India follows with 22% of the AUM, but it's worth noting it carries the highest regional GNPA at 6.5%. East India holds 16%, West India 11%, and broad partnerships account for the remaining 15%.
That brings us to Section 4, measuring growth and disbursements. Let's check out their momentum and see how this translates to actual cash flow.
Look, a high AUM is fantastic, but the real question is, are they still actively getting money out the door? The answer is a resounding yes. We're seeing a really steady 5% quarter-over-quarter growth in total retail disbursements.
They moved from 509 crore rupees in Q4 of FY26 up to roughly 534 crores in Q1 of FY27. And remember how I mentioned they entered the two-wheeler market back in 2008? Well, that specific decision is still paying massive dividends today, because two-wheeler loans currently dominate a staggering 79% of that total disbursement figure.
But hey, if you want the true indicator of their core business resilience, focus on this single metric, a 23% year-over-year growth in the MCSL retail portfolio. I mean, a 5% quarterly bump is nice, sure, but a 23% annual jump in a segment that makes up 84% of your business, that's huge. That signals exceptional market penetration and a highly active sales engine driving their foundational product. All right, Section 5, Asset Quality and Risk, checking the vitals. This is arguably the absolute most critical part of any lender's financial report card. How well are they managing bad loans?
So here's the magic number, 3.94%. That's their overall gross non-performing assets percentage, or GNPA. And why is this so exciting for them? Because it literally represents a massive 182 basis point drop from the previous year. In the lending business, dropping your bad loan ratio by nearly 2% year over year while simultaneously growing your overall portfolio is an incredibly difficult needle to thread.
To really wrap our heads around their risk management, we need to compare two things. We've got the gross NPA at 3.94% and the net NPA at 2.36%. Just to break that down simply, gross risk is the total percentage of loans that have gone bad. Net risk, that's what's left over after the company sets aside money to cover those expected losses. The fact that their net NPA is squeezed all the way down to 2.36% proves that their risk management team is aggressively and successfully provisioning for potential defaults, fully protecting the bottom line. It's a major victory for their internal controls. Finally, Section 6, Strategic Partnerships and Recovery. Let's zoom back out and look at the broader ecosystem to see how Muthoot uses these strategic levers. First up, their co-lending ecosystem, which, if you remember, makes up 15% of their total portfolio. The strategy here is smart. They aren't trying to conquer the whole market completely solo. They're teaming up with strategic partners to really multiply their reach. Greaves Finance is their largest co-lending partner, taking up nearly half the pie at 49%. This is followed by Wheels EMI at 26%, CreditWise Capital at 19%, and Monba Finance at 6%. This whole strategy lets them deploy capital through specialized channels without having to bear the entire operational burden themselves. And this data brilliantly illustrates exactly how they handle the loans that actually do go bad. Muthoot actively uses asset reconstruction companies, or ARCs, which are specialized firms that basically buy up bad debt to recover it. It's how they clean up their books. With Phoenix Arc, for example, they achieved a remarkable 75.60% reduction in principal outstanding. They brought it down from over 235 crores to just 135.62 crores. At the exact same time, security receipts dropped from 102 crores down to under 25 crores. We also see active engagement with Prasadiya Arc. They are actively converting stress assets right back into liquidity, ensuring that deadweight doesn't slow down their momentum. So, all of this leaves us with a really thought-provoking question. Muthoot Capital has clearly shown some serious resilience in Q1 FY27, shrinking those bad loans, aggressively growing that retail portfolio by 23%, and smartly leveraging partnerships. But as digital lending accelerates and the whole market shifts, how will traditional NBFCs continue to adapt and evolve in this rapidly changing landscape of consumer finance? It's a fascinating trend to monitor for sure. And armed with all this data, you are now perfectly positioned to keep tracking their journey. Thank you so much for joining me for this explainer, and as always, keep learning.